We've seen this hit in energy and oil, and if we look at the percentage of energy to the S&P 500, it represents a small percentage. However, there are other effects on the markets. For instance, energy is a highly leveraged sector, and with that, the regional banks could be impacted. Of course, high yield bonds would be impacted, BDCs would be impacted. And so this has been a punch to the stock market to say we have more to be concerned about than the coronavirus, which of course has been a large concern, and we've seen demand come to a halt. So that's where we are.
Right. What's your advice, Loreen, to clients? What should people do? Do they look at energy like some have a suggestion and say this is a historic investing opportunity? Or do you say here's how to protect yourself against exposure and do something totally different?
Well, the way we see the world is that we just experienced a bear market rally off the bottoms that we experienced in March. But we believe that we are in a cyclical recession. So what does that mean? That means most likely more like a W than a V-shaped recovery. And with that, most likely testing lows again in the market. So be ready for the downside. With that, we see there are buying opportunities, and we're looking for those buying opportunities in the areas that we like, areas that we've liked since before the coronavirus, BC, as I would say, and that would be areas like healthcare continue to be strong. What we're going to see, though, is that we see companies pushing out guidance, withdrawing guidance, and so that makes it difficult to value those companies.
Exactly. Kind of left flying blind to some extent. Joe, you also like healthcare, you like technology, which is pausing or taking a break today after a pretty strong run the last couple weeks. Are you going company specific? Talk to us about how you'd pick winners.
Sure. I think we're looking for long-term secular growth themes. It's no surprise to anyone that, of course, what we're living through right now is without question going to have an impact on consumer behavior and business behavior. But when you kind of look at what's going on, I think the retail sales numbers that we got just last week, for example, highlight just this divergence, if you will. There are going to be companies that are going to make profits. There are going to be sectors that should fare out better than others. And I think what we're trying to do is ultimately just exploit those inefficiencies in the market and look for those long-term secular growth themes so that we can add exposure to them in client portfolios. I'd also add that we really cannot forget or neglect just this unprecedented amount of both monetary and fiscal stimulus. There are a number of unanswered questions out there as it relates to the economy and the shape of this economic recovery once we get there. But certainly, without question, the stimulus is going to be supportive to financial assets, and we think that's part of the reason why markets have come off of the lows that we saw back in March.
Your favorite investment right now is?
Well, I would say overall we have a pretty significant overweight to the United States. When we look at the U.S. relative to the rest of the world, it's arguably our biggest call is from a regional perspective. But if we take that sort of one layer deeper and we look within U.S. equities, we continue to favor technology. And, of course, we've also added more exposure to healthcare, thinking of things like digital health, telehealth, for instance. These are areas of the market that we believe are likely to see some long-term growth and represent some opportunities for long-term investors.